Did you claim the Foreign Earned Income Exclusion last year? And this year you claim the foreign tax credit? And you are thinking that you're going to claim the Foreign Earned Income Exclusion next year? Be careful. This is what I call the Foreign Earned Income Exclusion flip-flop mistake. And while it does not automatically mean you will be audited, it can become an IRS review issue if your return history is inconsistent. Many US expats use one or two common strategies to reduce double taxation. First, the Foreign Earned Income Exclusion, usually claimed on Form 2555. Second, the Foreign Tax Credit, usually claimed on Form 1116. The problem is not comparing the two. In fact, you should compare them. The problem is switching casually without understanding the election and revocation rules. Here is the key rule. The Foreign Earned Income Exclusion is elective. You choose it by completing the relevant parts of Form 2555. The IRS says that once you choose to exclude foreign earned income, you cannot take a foreign tax credit or deduction for taxes on income you exclude or could have excluded. If you do, one or both choices may be considered revoke. And if you revoke your choice, the IRS says you generally cannot claim the exclusion again for the next 5 tax years without IRS approval. So what does revocation means? Revocation means you are telling the IRS that you no longer want to use the exclusion. The IRS says you can revoke the choice for any tax year by attaching a statement to the return or amended return for the first year you do not want to claim the exclusion. That statement must specify which choice you are revoking. But here is where taxpayers get into trouble. Sometimes they do not intentionally revoke anything. They just stop using Form 2555, switch to Form 1116, and later try to use Form 2555 again. So, was it a strategy change or is it a revocation? Let's use a simple example. In 2023, a US citizen living in Australia claims the Foreign Earned Income Exclusion using Form 2555. In 2024, they decide to claim the foreign tax credit instead because Australian tax was high and the credit looked better. Then, in 2025, they switch back to Form 2555. That pattern may raise a question. Did the taxpayer revoke the Foreign Earned Income Exclusion election in 2024? If yes, then claiming Foreign Earned Income Exclusion again in 2025 may be a problem unless IRS approval was obtained. Why this can become an IRS review issue? To be clear, I am not saying this automatically triggers an IRS audit. But if the IRS reviews the return, this inconsistency may become an issue. The IRS may look at whether you previously filed Form 2555, whether you revoked the exclusion, whether you claimed a foreign tax credit on income that was excluded or could have been excluded, and whether the 5-year rule applies. Form 2555 itself asks whether you previously filed Form 2555 and whether you ever revoked the exclusion. Here's the common foreign earned income exclusion and foreign tax credit mistakes. First, letting tax software switch between foreign earned income exclusion and foreign tax credit without understanding the election history. Second mistake, trying to exclude income and claim a foreign tax credit on taxes connected to that same excluded income. Third mistake, not tracking which years Form 2555 was filed and which years Form 1116 was used. Fourth mistake, catching up multiple late years without reviewing the strategy across all years first. And fifth mistake, choosing foreign earned income exclusion without considering other tax credits such as child-related credit planning. Now, switching strategies is not always wrong. There are situations where the foreign tax credit may be better than foreign earned income exclusion, especially for expats living in higher tax countries. There are also situations where foreign earned income exclusion may still be useful. For example, where the taxpayer lives in a low tax country, has qualifying earned income, and clearly meets the tax home and bona fide residence or physical presence test. The point is not that you must always use one method. The point is that the decision needs to be intentional, documented, and consistent with the IRS rules. Before switching from foreign earned income exclusion to foreign tax credit or foreign tax credit back to foreign earned income exclusion, ask these questions. 1. Did you claim Form 2555 in a prior year? 2. Are you claiming a foreign tax credit on income that was excluded or could have been excluded? 3. Did you attach a revocation statement? 4. If foreign earned income exclusion was revoked, are you still within the 5-year restriction period? 5. Does foreign tax credit produce a better result this year and in future years? 6. Are there child tax credit, foreign account, superannuation, investment, rental, or business entity issues that change the bigger picture? This is not just a one-year decision. The major takeaway is this. Foreign earned income exclusion versus foreign tax credit is not just a form choice. It is a strategy decision that can affect your future years. If you have always used foreign earned income exclusion, do not casually switch to foreign tax credit without reviewing whether you are rebooking the exclusion. And if you stop using foreign earned income exclusion in a prior year, Do not casually switch back without checking the 5-year rule. If you are a U.S. citizen or green card holder living overseas and your return history includes Form 2555, Form 1116, late filings, foreign taxes, or switching methods, get the position reviewed before filing. This is especially important if you live in a high-tax country like Australia, have children, investments, foreign accounts, superannuation, or foreign business entities. Unsure which strategy applies? Book a clarity call with us today. Email us at hello@usautax.com.